Traditionally, telecom companies have operated as vertically integrated entities, owning and controlling both the physical network infrastructure, such as fiber optic cables, towers, and exchanges, and the services delivered over these networks, such as voice, SMS, and data. But keeping up with the latest and greatest network technology has started to get expensive. 5G and FTTH, fiber to the home, rollouts have required massive capital investments for telecom companies. And these new economics are starting to raise some questions about all this duplicated infrastructure. Namely, should each telecom service provider really run its own network? The concept of network separation, a growing industry trend, says no, maybe they shouldn't. Network separation means splitting the telecommunication company's infrastructure into distinct entities: the NetCo, which runs the network infrastructure assets, and the ServCo, which runs the services provided over it. Once separated, the network, acting as NetCo, can then sell network access to any number of ServCos, maximizing the utilization of its assets. You may hear the phrase Telco Infrastructure as a Service, TIaaS, which refers to the business model of selling access to NetCo resources on a subscription basis. A network separation can be full or partial. Some telecoms are opting, for example, to split off only a subset of the network infrastructure. For example, separating the towers into a TowerCo or the fibers into a FiberCo. In some cases, particularly in the past, this separation has been regulator-driven. For example, BT, formerly British Telecom, was forced by UK regulators to separate from its part of its network operations, Openreach. Regulators wanted to foster competition and ensure that Openreach was providing network access evenly to BT and BT's competitors, Vodaphone and O2. However, the trend of network separation is not simply about regulation. Many telecoms are choosing this path on their own. For example, Vodafone Group created a separate TowerCo, Vantage Tower, which now works with Vodafone and its direct competitors. Major telecom groups like Orange, TIM, and Telstra also performed similar separation deals. In addition to the financial benefits of sharing network assets across ServCos, this split has a second benefit. Once split off, it's easier for the new NetCo to find low-cost capital. Independently operating NetCos have a lower risk profile than vertically integrated network operators. To investors, they look more like other infrastructure projects, such as power plants, good long-term investments with reliable returns. Indeed, institutional investors are already helping catalyze more of these separations. For example, in 2023, the Italian incumbent TIM sold its fixed network NetCo to the global private equity firm KKR.